If you're looking to create a set of financial projections for a party bus or a limo rental business, then you've come to the right place. We have created a financial projection spreadsheet template built specifically for this type of business model. And just a little bit of background about us before I dive into how the template works and how to fill it out. We are a company focused on helping entrepreneurs create financial projections for potential investors and lenders. And we started ProjectionHub about a decade ago, and since that time have helped over 50,000 entrepreneurs create financial projections for all sorts of different industries and business model types. So we specifically built this template to help that kind of party rental bus or party bus rental or limo rental type business model, and specifically focus on trying to help you with your pitch and presentation to potential investors and lenders. I spent a decade as an SBA lender, a small business administration lender, where during my time at the lender, we closed over 1,000 small business loans. And so I reviewed a lot of loan applications and looked at a lot of financial projections. And one thing I can tell you from that time is that although your projections are not what is going to automatically get you approved, it is something that could get you denied. If your projections are really bad, or they just don't make sense, or they're in formats that are not appropriate or standard, that is a good way to scare away potential investors and lenders. And my goal here is to try to help you at least overcome that hurdle in an easy way, get a solid set of projections that you can use for your business as you're pitching to investors and lenders. A couple more things before I dive in. We will put a link in the description of the video below to this template, so you can go grab the template and follow along. And also, as a thank you to you, if you stick around to the end of the video, I'm going to give you a discount code that you can use to take a discount off at checkout as our thank you for sticking around. With that, let me go ahead and dive into the model. Okay, so this is our at a glance tab. So at the end of the entire process, once you've filled out all of your assumptions, this is what you're going to get. Some different charts and graphs and key ratios and key summary data that you'll be able to pull into a business plan or a pitch deck. You're also going to get a 5-year cash flow statement, a 5-year income statement, and a 5-year balance sheet, all annualized. But you'll also get the monthly level detail as well of the income statement, cash flow statement, and balance sheet. So you get the monthly detail as well as the annual summaries. Now, in order to produce these reports, we have a little bit of work to do. We need to go back to our input assumptions tab here and start taking a look at how to fill this out. So the first thing you need to know is that any assumption or any field that is highlighted in blue is an assumption that you can change without breaking anything in the model. So we can set our company name here, and we have a projection start month of January 1st. And we have a starting cash balance of $150,000, which is our personal investment. So let's say we're going to put $150,000 in personally in month 0, so at the beginning of the model, to serve as our starting cash balance. Now we have the ability to put in accounts receivable and accounts payable terms and starting balances. Now, this could be if you're an existing business, you may have accounts receivable or payable terms and balances already. But to start with, I have this set at 0. We also are going to assume that the average days to receive payment here is 0 as well, meaning your customers are going to pay you upfront or when you provide the service. On the accounts payable side, this is assuming that you're going to pay all of your bills within 15 days. If you get billed, you're going to pay within 15 days. Some expenses you may pay upfront, some expenses you may get 30-day terms to pay. And so that's what we're looking at here. Next thing we want to enter in here is our fixed assets. And these are assets other than the limos or the party buses, okay? So these are things like other equipment. So this could be like a lift in your shop to do maintenance on the vehicles. And it could be leasehold improvements. So let's say we rent a dispatch lot and a maintenance building for our business, and we did $75,000 worth of leasehold improvements to get the property ready for our business. That's what we would enter in here. We can say we purchased these in month 1 of the model, so at the beginning of our projections. Okay, so now here we get into where we add the actual vehicles that we have available for sale and rent, right? So let's say we've got these 4 party buses here. And what you can do is enter in the name of the vehicle and then the number of vehicles. So technically you could, if you wanted to buy a batch of 4 party buses all at once, all at the same time, you could put 4 in here, for example, and it would multiply the cost of the vehicles and everything out that way. But we're just going to do this one by one in this example. We can also select whether we're purchasing the vehicle or leasing it. So we could lease the vehicles, and you'll notice if you select leased that the sections that are now irrelevant will be blacked out, and instead we'll just be left with this monthly payment per vehicle here for the lease. Now, if we change this back to purchased, we'll notice that the monthly payment per vehicle, this is the lease payment, has now been blacked out, and instead we're going to need to know the purchase details. So we'll have purchase details like a $70,000 vehicle price. We're assuming 5 years until sale, meaning we're going to utilize this party bus for 5 years in our business before we sell it for scrap or salvage value. And we're assuming that salvage value or scrap value is going to be $10,000. We can select what month we purchase the vehicle. So here we're assuming this first vehicle we purchase in month 1, and then month 7, 13, 19. So we can see how we're expanding our fleet. And then we can say what percentage of our vehicle are we financing, are we getting a loan for? And so you'll notice that I have this set up as an equation, and it's equal to the purchase price times 0.8, which means we're financing 0.8 or 80% of the vehicle value at an 8% rate with a 72-month loan term. So you'll be able to enter in vehicle financing loans really for each of the vehicles that you add, but you can also add just a separate loan here. This could just be a working capital loan or kind of a loan that isn't tied to any specific vehicle. So we've got an SBA loan in here that we're assuming for $100,000 with month 1 interest rate of 8% over 84 months. So this is the input assumptions tab. Next, we'll jump over to our input revenue and cost of goods sold. Now we have 2 types of revenue structure that we can use here. So we've got this bus plus a driver. So this could be the party bus or a limo type of a model where you have a driver, or just a bus rental. So this would be where maybe you're a small sports team and maybe you already have a driver, but you don't have a bus, and so you rent the bus to take the team to the game, right? And so you're just renting the bus, but you don't need the driver. So this could be that type of model where there's a per day fee, but no driver included. So what we've done here is for each vehicle that we listed, so we've got the party buses, and then we've got 3 rental buses and a rental coach. And so we've got these first four set up with a bus plus driver. And then these are just pure bus rentals where there's no driver included. So now we need to fill out assumptions for all of the party buses here that have the bus plus driver. So we're going to assume average rentals per week is 2, the average rate per hour of $150, and the average hours per rental is 6. And we're also going to assume that we have an average charge of $1 per mile in addition to that hourly rate, and that the average total miles per rental is 20. And here we're saying the average billable miles is 10. So in this example, basically what we're saying is you get the first 10 miles for free as part of that hourly rate, but then beyond that 10 miles, you're going to pay that mile per mile rate here. And then here you can just do any additional fees per rental. So this could be like insurance costs. We've got $25 per rental here. So this will then allow us to enter it or to set up all of our vehicle revenue assumptions. And then we can enter in variable costs like driver compensation. So this is your direct labor of $30 per operating hour. And then variable costs like fuel, maintenance, repairs that we can set as a cost per mile basis. And then finally, a per rental cost like cleaning the bus at $25 per rental. So that will allow you to calculate your cost of goods sold on the bus plus driver. Okay, so this section now is just the revenue assumptions for the bus rental without the driver piece, right? So here we're assuming that rental bus 1 is going to be rented for 20 days per month on average at a day rate of $350 per day. We can enter in those assumptions again on average charge per mile and additional fees like insurance that we want to add in here. Same deal here with variable costs on a per mile and a per rental basis. Now you'll just notice that we don't have the direct labor cost here because we won't have a driver in this scenario. All right, now going over to our input other operating expense tab here, we can input our expenses here and put them in different categories. And the key thing I want to point out here is you can set the expenses in a few different ways. You can set it as a fixed dollar amount. So let's say rent is a fixed dollar amount, $7,500 a month. It's just the same each month. But then there could be expenses like insurance that are on a per vehicle basis. So we've got this set as $150 per month per vehicle. And the model will automatically calculate how many vehicles you have at each month based on your assumptions and apply that $150 fee. And then we could have expenses that are a percentage of revenue, like advertising. So we can select percentage of revenue, and we can enter in 0.07, which represents 7% of total revenue as an advertising expense. All right, now finally, we can look at our salary and owner draw tab here, and we can have, let's say we have a manager and a part-time admin with these annual compensation rates and benefits. We can say what month they started, month ending is month 60, so the end of the model. And we've got one of each of these employees, and we're going to give them a 5% annual raise. So that's all the assumptions. Once you've done that, you're back to where we started here on the At a Glance tab. You'll be able to now take this and hopefully pull it into a business plan or pitch deck, or send this directly to your lender, and your lender would be able to then play around with some of the assumptions and utilize that in the underwriting process. If you have any questions at all, please don't hesitate to reach out at support@ProjectionHub.com. And again, as a thank you for sticking around to the end, as we promised, if you go down in the description of the video below, there'll be a link to a form that you can fill out. If you fill out that form, we're going to email you our most up-to-date coupon code that you can use at checkout to take a discount off the purchase price of this template. And again, if you have any questions at all, please leave a comment in the video comment section below, or reach out directly at support@ProjectionHub.com. We'll do our best to help. Thanks.